Tesla reported Q2 2019 earnings yesterday, and the result is not that good. The reaction from the stock market was pretty ugly. We'll take a look at the numbers and some of the highlight and low light, and take a little bit beneath the surface and see what are some of the positive and what are some of the opportunities here. Let's go back and take a look at what the projection were. The market was projecting a loss of 42 cents with a revenue of $6.42 billion. The gap, it lost $408 million. The non-GAAP is 198. And this is the ugly. The GAAP EPS is a loss of $2.31, and the non-GAAP is $1.12. The street was looking for somewhere around 42 cents loss. So this is a big miss here. The revenue is $6.349 billion. So in the automotive revenue, $5.376 billion. Got a little bit less of the regulatory credit compared to the previous quarter. The margin is only 18.9%. Guess that's one of the things that the streak is concerning about, the declining margin. And here's some of the highlight from the company. And what we see is it generated a free cash flow of $614 million. So that's a good number. The bad thing is this right here, right? The net loss of $408 million. And that's including a $117 million on restructuring charge. So again, it delivered a record number of vehicles during the quarter of 95,256, and also a record number of vehicles produced, 87,048. So it again generates $614 million free cash flow for the quarter, and the company ended with a total of $5 billion of cash and cash equivalent as of end of Q2. And that's including $2.4 billion of public offering and the recent bond issuance. So it's the highest level in Tesla history. Going to some of the highlight for individual model. The Model 3 again, deliver a record number of cars, 77,634. Also, the company indicated that the majority of the Model 3 order for the quarter was the long-range battery option with a ASP of around $50,000. And they also demonstrate the Fremont plant could produce 7,000 Model 3 vehicle a week. It is aiming to produce 10,000 total vehicle, that's including the S and the X, by the end of 2019 in the Fremont plant. For the Model X and the S, it is running on a single shift. It produced over 14,500 vehicles in Q2 and delivered 17,722. The Gigafactory in Shanghai, last quarter, they started moving some machinery into the facility for the first phase of production, and it is targeting that line to produce, that factory to produce 150,000 cars per year, 150,000 Model 3 per year. The company is targeting a 500,000 car production in a 12-month period ending June 30th, 2020. The Model Y, it has started preparation for the Model Y production in Fremont. It is believed that the Model Y will be more profitable than the Model 3. That's probably because of the higher ASP, and also probably the leveraging of the Model 3 component and some of the lesson learned in the manufacturing process. So that might have probably attribute to the projection of possibly lower manufacturing costs and also a little bit of a higher margin because of the higher ASP. Then in the infrastructure, it also indicated that the company have added 101 vehicle to the mobile service fleet. and also opened 25 new store and service center. And the supercharger network have grown to roughly about 1,600 location worldwide. The outlook, it is continue to still maintaining a target of producing Model 3 in China by the end of the year and the Model Y in Fremont by fall 2020. And it is still targeting to deliver a 360,000 to 400,000 vehicle for 2019 for the year. It is expecting positive quarterly free cash flow. And also the company indicated that the business has grown to a size that it is being self-funded. Some of the other highlight, the other expense and interest increased to 202 million versus 123 million from previous quarter, and that's probably caused by the weak dollars. Also, the higher interest rate that has to pay for the recent bond issuance. The capex, they spent $250 million in Q2. That's including in the tooling up on the Gigafactory in Shanghai, and also the expenditure of the charging infrastructure, along with the preparation of the Model Y production line. Let's take a look at the Tesla stock chart here. This is the 30-minute intraday chart that's including the after hour. And yesterday, right before the earning, it closed at somewhere around 265. You can see as earning came out, this just dropped down to this lower target here, what the market was pricing in, somewhere around 238. So I have a low volume zone here at this 237 area. So you can see that it came to that target area and then found some support around these zone here, this 238 and also this low volume zone. So it's kind of hover around there for a little bit and for the remaining of the after hour session. If you like the contents in this video, click the thumbs up. If you are not a subscriber of my YouTube channel, subscribe and also click that notification icon so you won't miss any future video from me. Now taking a look at the 4-hour chart here, that's including today's price action. So you can see this is today a gap down on the open. I came down here, so it's went down to below the 230 level. Right now it closed at 228. And the low here, we can take a look at it. The low is actually 225.55. So it closed at 228.81. Remember in the video, the pre-earning video that I put out a few days ago, we were talking about the first level of support that I'd be looking at if we get disappointed earning from Tesla. Then it will be the 246 level. And that would be this particular low volume zone. And if that doesn't hold, then we'll basically come down to this 237 low volume zone that we also just looked at. This is the range of what the market was pricing in. On the low end was 238, and on the high end was close to 278. So unfortunately, the earning wasn't stellar because if you look at it here from this low here, somewhere around 177 to the 265 close, that is almost a 50% run up from the low. Unless Tesla really came out with stellar earning, and the market was expecting a loss of 42 cents to keep this thing going. It has to really beat that number, but unfortunately it did not. And it reported non-GAAP $1.12 loss, I believe, from the previous slides that we looked at. Or either that, they report a much better margin than they would have presented, which is slightly less than 19%. And if they were able to report a operating margin of somewhere around maybe 20+%, then that might help to keep this momentum up. But unfortunately, neither of those two items actually came out to be favorable. As a matter of fact, I think the analyst is looking at that margin with a little bit of concern because it's been the 3/4 of low declining margin. So So hopefully this coming quarter, the next quarter, the margin will improve, and that's why the price really reflect the disappointment. Right now, basically looking at this area here, because this is pretty much of a high volume area. What this entails is essentially at this price range, there has been a lot of acceptance. In other words, the buyer and the seller is willing to do business here, and for every seller there's a willing buyer to buy at this range. So until if the buyer could absorb all the selling in this area, then we might see price start making its way back up. Otherwise, if the buyer goes away, or they're just too much of a seller and doesn't have enough of buyers to absorb the selling, then I'd be looking for the price to work itself down to this particular low volume zone here, somewhere around 216. If it's unable to provide a rejection and push it back up, then I'd be looking at this 211 price level here. If the price continue to drop, I'd be looking at these areas here. When it comes down to this area, I'd be interested in looking for some type of setup for a bounce, to play a bounce to get back up into this high volume area here, and then possibly get back and test this zone here at this 237.